Happy Friday, traders. This is Fawad Razakzada, market analyst for City Index. Today is the 10th of January. So the markets are a little bit quiet ahead of the release of the jobs report from the US. The dollar is largely holding on to its recent gains. It is testing or nearing the highs that were hit last week. And the dollar index is remaining above the 109 level and near the 110 psychologically important level after breaking several resistance levels last year. So the trend is quite bullish, and for this trend to remain in place, we will need to see continued strength in US data to justify the recent hawkish repricing of US interest rates. In terms of the jobs report then, the headline figure is expected at 164,000 versus 227 the previous month, with the unemployment rate seen unchanged at 4.2%. Watch out for revisions, because we usually do get revisions for the prior numbers, and last month's better than expected number could well be revised once again, as we have seen in the past. Meanwhile, average hourly earnings are expected to increase by 0.3% month over month. So it's important to take all of these factors into consideration when making a trading decision based on the jobs number. In terms of the major currency pairs to watch, the euro dollar could move on the back of the jobs report. Currently, the trend is quite bearish, with the price making lower lows and lower highs. It has broken several support levels in the last several months, causing the 21-day exponential moving average to point sharply lower, suggesting that the near-term trend is indeed bearish. So for things to turn positive on this currency pair, we'll need to see the break of this bearish trend line first and foremost, and that can only happen if we see a run of weaker than expected US data in the weeks ahead. But will that be the case? It remains to be seen. If the trend continues to remain in place, then the next downside target could be liquidity below the previous week's low at 102.24. So the 102 level could be the next downside target, followed by 101 and potentially even parity in the weeks ahead. On the upside, resistance comes in at around 103.40 to around 103.70-ish, marking the previous lows and the resistance trend line. Above that, we don't have anything significant until the 104.60 to 105 area, this shaded red region. Here's a daily chart of gold. Now, despite the renewed dollar strength, the precious metal has risen in the last few days, albeit it hasn't made a new record high ever since peaking at 2,790 back in the end of October. So it has created a few lower highs, and if I connect a trend line, you can see that it is coming up to test this resistance trend of its consolidation pattern, you could call it, at around 2,670 to 2,680-ish or 85, where it is trading at the moment. So let's see if the jobs report will trigger either breakout above this trend line or causes a reversal. If it causes a reversal, then watch out for potential support to come in at around the trend line. And if the trend line breaks, then 2,600 is the key level of support that I'm watching. Below that, we have 2,580, marking this high here. And then this region is a major support area I'm monitoring, because we have the 200-day moving average converging with the psychologically important 2,500 level there. But for gold to get down to this area, it will take some effort from the bears, because the trend is clearly still bullish, and it remains to be seen whether we'll see that breakdown. So it's important to wait for the appropriate signal to form on gold, whether you're bearish or bullish gold trader, because right now it is bang in the middle of nowhere, testing the resistance trend of its recent consolidation pattern. Now, for more market analysis and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.